What you need to understand about SMCI in order to trade Supermicro and the next hot swing trade on the long side that nobody's talking about right now, but will soon next. Welcome to Hot Trades of the Day. My name is Daniel Wilhelmi, head of trading here at Bullmarket Lifestyle, your daily show that focuses exclusively on trades and swing trading ideas for the coming days and weeks. Well, I'm on vacation and obviously there are some technical difficulties. Why would it be any different? So no charts today, which is fine because we're going to start talking about Supermicro and what's going on. As you know, the stock has been breaking down. Now it rebounded yesterday, but not as strong as you would think. It got sold into strength. Yes, it closed in the green, but it couldn't hold the highs. The highs got sold, which is a bearish sign on a rebound after a breakdown like this. And that leads me to the important point that a lot of retail investors don't understand, and you need to understand in order to build a strategy to act the right way with a stock like Supermicro. Okay, so let me explain it to you in sports analogy because most people get that. I'm a big college football fan. Go Dogs! I went to University of Georgia and I went to Arizona State. So those are my programs that I support. And if you like college football, then this will really resonate with you, what I'm trying to tell you and how it translates to SMCI. With the transfer portal and senior classes graduating and new freshmen coming in, no college football team from the past season is like this season. So let's take Michigan, national champion last year. Would you bet your house that Michigan is going to repeat this year as national champion? You would say no, because they lost their quarterback, they lost a ton of draft picks, they lost their coach. It's a completely different team. So your decision to decline the bet of your house on this year's Michigan team based on the results of last year's Michigan team is correct. And it's the exact same with companies. I got asked yesterday, Daniel, the stock from SMCI went down 60% from the top to now. This got to be a great buying opportunity. Yes, if it was the same company, but it isn't. And that is the thing. That is the mind flip that retail investors can do that they don't understand, that really separates them from the professionals. The professionals, they don't get emotionally connected to stocks. So they are capable of taking a step back and seeing what's really happening. Besides SMCI probably being significantly overvalued, prices over $1,000 in the spring, it is not the same company anymore after these acquisitions by Hindenburg Research as it was a month ago, or 2 months ago, or 3 months ago. Besides that, we see in the chip sector the growth rate slowing down, which is also a change of what we had half a year ago. Okay, but in case of SMCI, we also have these acquisitions of Hindenburg Research. It doesn't matter at this point if they're right or wrong. The only thing that matters is that now we have a different situation and therefore a different company with different risks and different rewards. So don't look at the past and say, oh, the stock went down 60%, I'm gonna buy it now. Look at the past and then put it into context. Where is the company now? Microsoft, for example, That's the same company now that was 6 months ago, maybe a little better. But SMCI is not. So don't use the past downturn of like 60% as a reason to buy the stock. The only reason to buy the stock right now would be a stronger chart setup and an increased money flow, which would show that big money is coming into the stock, which I doubt will happen until the Hindenburg Research accusations are resolved one way or another. So stay away. I always say that. It's one of the mantras of Bull Markets Lifestyle. You don't need to be in every trade. You just need to be in the right trades. SMCI right now is not the right trade because we have a big black box on the risk side that we cannot judge. So we're not taking this risk. A way better setup right now that unfortunately I can't show you the charts. I wish I could. I hope I can do it on Monday. Look at the grains, especially soybeans. Soybeans just held. Not only does it held the ultra long uptrend that's valid since I think 2000 or 2001, it also just broke the medium downtrend. We have record short positions of the hedge funds in the grains because we had mid to long-term downtrends in the charts, and we had a record harvest season in all the grains this summer, with the numbers being even above historical averages. And that pushed down the prices. It was easy money for the hedge funds. So they're short. They're short up the gazoo. But what does that mean? That means if the prices turn just a little bit, which is happening right now in soybeans, in wheat. Yesterday in corn, we saw a jump of 7 or 8% to the upside out of the blue. How does that happen? Short squeeze. First hedge fund panicked, started closing short positions. These are small markets, right? The grain markets, as far as the trading volume, if you have record short positions, you can't get out that easy. You have to bid up the prices for that. And that's what we saw with corn. So if we just get a little bit of an uptrend, the heat is really turning up on the bottoms of the hedge fund managers. And we saw it in corn, we only need one to panic and start closing out the short positions. And then everybody else will follow and we'll have a gigantic short squeeze in the grains. That is the easy trade right now on the long side, the hot trade that nobody is talking about right now. Take a look at it, look at the charts. You will be surprised what you will see because nobody's talking about this right now. I wish you a good weekend. Enjoy your weekend. Do one thing, just one thing, that brings you closer to building the life that you really want to have. And do numerous things, doesn't matter how big or small they are, that brings you joy. Because life is short. We see us on Monday. Have a great